So today's cardinal lesson, we're talking about annuities, and we're talking about purchasing an annuity with some of the money that's in your portfolio now. Okay, that's just one example. You can get the money from anywhere, savings account, brokerage account, uh, in your investment portfolio. But we're talking in terms of taking some of your money and taking the risk in off the table. You still have risks with these things, but they're much less. And purchasing a guaranteed annuity. And in this example here, it's 200,000, and we're showing you what the effect of this will be on this portion of your money 10 years later. It's why you would do one of these particular ones. And we're going to be going over an example of a 10-year MIGA. MIGA stands for multi-year guaranteed annuity. And then we're going over an example, one for a couple, and it's really the same policy for a single person. And with that, I want to bring it to Tom to just really talk about why we're doing this video. Why did we select this today?
Yeah, we're doing this video really to show you some options if you're really worried about market fluctuations. You lived through 2022, you saw the accounts go down. Hopefully they've recovered most of it, but you're just worried about what that looks like going forward. This is an alternative option opposed to stocks and bonds as a way to lower the risk in your portfolio and have it become safe. So let me bring up the show notes. You can find these at below our video at the link. They're on our website as well in the show notes section. Again, we have the board like always, and then we'll spend a little bit of time here, but we're going to mostly spend the time on the board. Is we have the illustrations that represent the three columns we have on the board. This is the first one. You'll notice all the highlighted numbers are the ones that are represented on the board, so you can find them pretty quickly. This is column one. This next one is column two. Again, we'll give you more details here in a second. And then the third illustration is column three. So if you want to read more into the details, understand how these work after you watch the video, you can find these in the show notes. I will point out that these can be state specific. So if you're in a different state, we ran these in North Carolina, they might be a little bit different. The interest rates can change based off the time. So depending on when you watch this, they might be a little bit different. So again, they can be a little bit different, but right now, at the time of this filming, this is what they currently look like.
Okay, so first up, we've got the $200,000 annuity, which is the same amount on all of them. And the example we're using is a 65-year-old person, but the age really doesn't matter on this other than if you were like 85 or older, then certain companies will not offer annuities like this, 85 or 90, but short of that, you can buy these. The age really doesn't matter. So this is about the simplest, most straightforward annuity that we sell. And this one is a 10-year annuity, which means if you try to draw all the money out during the 10 years, you're going to pay a penalty for early surrender. But barring that, so when you put something in a 10-year annuity, you really, short of taking the interest out of it, you really don't, you only want to put enough money in here that you can lock it in for a period of years. So in the example, it's a 10-year annuity, and we have clients purchasing the 10-year period because simply they want to lock in this 5.6% interest for 10 years where it is not going to change. And we have people going for this and going for the 10-year period just for that reason alone. Now, the interest rates on the 5-year ones are about the same. I mean, it's just these are available from 2 years. Well, let's just go 2 years, 3 years, 4 years, 5 years, blah, 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 all the way to 10 years. There's even some companies that offer them longer than 10 years. I don't think we've offered one of those out to the public. So let's just say 2 to 10 years. We also have people who buy these where they buy them in a series, so they all come due or available at different times. Like they buy a 2-year, a 3-year, a 4-year, a 5-year, and a 6-year, so that every year one of them is coming due. But for the example, we just want to show you how the 10-year one would work. And we're going to really look at, okay, so what happens at the end of the 10 years? And in this example, you put in 200,000, the interest 5.6% interest. It's compounded. And then in 10 years, or in 2034, you're going to have $344,881. Now, this annuity is available for both IRA and non-qualified or not IRA money. So if you have money in a savings account, you have money in CDs, if you have money in your brokerage account in your portfolio, and you want to turn it into cash, roll it out of there, or you can just bring it out of there if it's a non-qualified account. If it's in an IRA, you're going to need to roll it over here out there and turn this MIGA into an IRA. So they're going to work with all kinds of money. If you also do this with non-qualified money that you're currently paying taxes on the interest, because this is an annuity, that's going to be tax deferred. So you're not going to pay interest on, not going to pay taxes on the accumulating interest. You also have the option with this company to just get a check for the 5.6% interest every month. So you could set that up. And what it's going to do is at the end of the 10 years, you're still going to have 200,000 in there. And then you're going to have to do something with that money. You can get paid out that interest every month, where they'll just send you a check. Now I want to turn it over to Tom, and Tom wants to talk about this annuity that's over here and why you would want to use that.
Yeah, and so column 2 and column 3 in the board are essentially the same thing, except the first one is for a couple, the one on the right side is for a single person. So I'll talk just generally about how they work. But again, if you're single, you're going to look at the numbers on the right side. If you're married, you'll look at the ones in the middle. And again, this one is dependent upon your age. The income specifically, we'll talk about in a second, is based off the age you were when you purchased it and the age that you start the income. So if your ages are different, the numbers will be different. We can run one for you if you're interested. But in the married couple, and then really on the right, we use 65-year-old for all of them just to keep it consistent. And how this works is, so you'll notice this sort of middle row that has this is really the account balance. Now, what's different between the first column, the MIGA, and these other ones that are really an income annuity is these numbers are not guaranteed. So these are projections. These could be different based upon the performance of the index. But again, it's projected to be the 294, which is less than what we have on the MIGA, the 344,000. So you say, well, why would I do that? Like even on the projected, it's not even as high as the guaranteed. The real reason you're purchasing this one in the middle is for the income. The guaranteed income is the main reason you would look at something like this. And what's nice about this is it guarantees an income in the future. Again, we've shown this starting at 75. You don't have to start it at 75. You could start it sooner. You don't tell the insurance company when you start it on the front end. You get to decide that later on. But right now we've illustrated starting at 75, and you get a known number coming in guaranteed for the rest of your life or you and your spouse's life if you're the married couple. And so the real reason you're purchasing this is just like Social Security. It would be just like a pension, is you get a monthly check coming in that will pay you for the rest of your life. So again, for the married couple, that number is $30,000 a year guaranteed forever, even if this account balance goes to zero. Let's say you live into your 90s or even to 100, pretty good chance that account balance has been drawn down to zero, but that check's still coming in no matter what. And if you're single, that number's a little bit higher. They give you more income if you're a single person than based off a couple, and it's $34,000 a year coming in, again, guaranteed forever. So it's really a way to set up, especially if you know you need a future income. This is a great way to do that. And one point I want to make on all of these is all of these are going to be built as part of a larger plan, right? None of these are just going to be, here's this, you should put all your money in one of these things. That's not how we operate. And so we look at the bigger picture. We look at all your assets. We would take a portion of them and do something like this as part of a larger plan. But we just want to give you an example of some tools that we use to build some of these plans out. Another point I want to make on this middle column and the right column, these income annuities, is this particular company is Midland National. Again, the illustrations are in the show notes. Is it has a provision just built into the policy that will double that income if either one of you, if you're a couple or a single person, if you cannot perform 2 of the 6 activities of daily living. So I'll repeat that, is that income, that 30,000, the 34,000 will double if you can't perform 2 of the 6 of activities of daily living. So it's a way to, it's not long-term care insurance, but it's a way to bring in more income at the point of the need of care. There's some provisions, there's some stipulations. So again, I don't want to get too far in the details there, but it's a nice thing to have. It's a nice way to have some coverage to bring some additional income in for care if it's needed in the future. And it doesn't cost me anything extra in the policy, which is one of the reasons we like using this company. Plus, they have a high income compared to some of the other companies we look at. So we're continuously shopping this around. These aren't the only companies we represent. We represent many. And so we're out here shopping around and making sure we're getting you in the best situation.
Yeah, and I think what Tom emphasized is we don't offer annuities in just a one-off thing where and it sounds a little bit like that today, where we're just going over a $200,000 MIGA and it's 10 years, it's 5.6%. And, if you had 200,000 and that's all you had, we might recommend an annuity for part of that, but we're not going to recommend you put all 200,000 in this one thing. Same over here. This is all part of a larger plan. These are tools, and we can put 100,000 in one of these. We can put 1,000,000 in one of these, and a lot of people that do plans, they end up with some of their money in one of these. They might purchase several of these of different terms, different lengths, so they're coming due at different times. And then there's other types of annuities that we may or may not use. And then the bulk of their money is still in an investment account for a lot of people, where they're just, we're managing that, or we're just advising them and they're leaving that where it was and taking all the risks and preparing for the future and trying to grow it. So we use annuities as tools to buy the guarantees, to buy the fact that they're not going to go down in any given year, and then to buy the income potential. And it's really longevity insurance that when you have a guaranteed income, for my wife and me, and it just doesn't matter which one of us lives the longest. If she lives a long time, the check's going to be the same. It's going to go on forever. So just want to emphasize these are tools that we use in a much larger plan. And within that scope, I want to check the boxes of what we've talked about. We talked a little bit about Social Security, because this would just be a supplement to your Social Security income supplement. We talked about long-term care in terms of the increase in the amount. We talked about IRAs and 401ks. We talked about income. That's what we're creating here. I don't know if we mentioned estate. Is if you were to die prematurely while these things are in their accumulation period, the cash value is just going to be paid out to the beneficiaries. So a lot of people ask that. I don't want to put all my money in an annuity, and then if I die, all that principal's gone. No, that's not how it works. Some annuities, that's how it works, but not with either of these. Is the cash value is going to be paid out. And if you start the income or 10 years later, and then both of you are pass away soon, there's still going to, like a couple of years after you start the income, there's still going to be substantial cash value that's going to go to your heirs. So we talked about estate, and then we talked about income taxes briefly. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.